friends, welcome back. In this session, we are going to discuss about open interest analysis and FNO lot size. Guys, as you know, that open interest is one of the important part of the derivatives studies. And in this session, we'll try to learn all the practical understanding of the open interest analysis. So here we go. So friends, as you know, my name is Chandan Taparia, MBA Finance, PGPBM Finance and Marketing. Having the experience of more than 1 decade in the Indian derivatives market, regular appearance on all the business channel including CNBC TV18, CNBC Awaaz, Zee Business, ET Now, regular writer and author for most of the derivatives and technical column, mainly in Money Control, Zee Media, ET Online, also writing for leading newspaper including Economic Times, Business Standard, Financial Express, etc. So again here I would like to share my experience that how exactly I learned the open interest and how we can use this indicator to predict the market movement or the stock specific action. So guys, first let's understand what is the open interest. The open interest is the total number of outstanding contracts that are held at the end of each day. When you talk about the open interest, that means the position which is still open yet not settled. You must be knowing that in our Indian markets, we have 3 contract months: current month, next month, the far month. And we have settlement on every Thursday. So every Thursday of the month, the current contract expires and then we have the new more contract. So then next one will be the current month and then next month and the far month. So just for an example, we have October. So last Thursday of the October contract will settle. Right now we are having November and December. So after the ending of the October, the January new 2021 contract will come into the existence. Now we need to understand that when someone is buying and selling, people are having their interest into that positions. We need to understand that what is the flow of that positions. First, it should be clear the open interest will happen when someone is buying and someone is selling. And this open interest is being calculated on one side. Open interests are total from one side, either buyer or seller, and not the sum of both. The open interest is somewhat similar to what we call a delivery volume in the case market. Just for an example, usually we say that particular XYZ company has seen the strong momentum. The volume was 5 times more than the regular volumes, and the deliverable volume were more than 70 to 80%, while the normal deliverable volume for the counter was 30%. So which indicates that there is higher activities, higher participation, higher volumes, and along with that, people are really carrying the position into their demat account, and that's why the deliverable volume is high. So when the particular stock is moving up, volume is also rising, and delivery volume is also increasing. We are getting more conviction that particular stock is likely to move ahead, because participants might be taking the positions with the view for positional point of view. When we talk about the volume, you don't know whether the people have bought and sold and they must have exited during the day because of the volatility. But deliverable volume means people are really taking the position into their demat account. However, they may sell it after a few days. But what we understand that if someone has really taken the overnight risk, he might be having the particular view on the counter. Now talking about the open interest, so open interest is somewhat similar to what the deliverable volume is called into the cash market. So we'll discuss in detail length to the open interest, and we'll also understand how to learn the open interest to predict the positive or the negative momentum of the counter. So if I just move ahead, the open interest suggests a couple of things, and we need to combine the open interest volume and the price to come the conclusion. So when I talk about the open interest, it increases when traders open trades, decreases when traders closes trades. A running total of all the open position in the future contract is taken care of. It indicates the cash flowing in and out of the market. While talking about the volumes, increases every time when a trade is open or close. Running total of all transaction for future contract is taken care of. So we will also understand what is the difference between the volume and the open interest. And in a couple of examples, I'll try to explain what is the role of the volume and what is the role of the open interest. Why we are talking about the open interest? Because derivatives is a zero-sum game. If someone is gaining, the other person has to lose, or vice versa. Because it's a zero-sum game. When someone is buying, other is selling, and as per the settlement or as per the exiting position in between, the debit and credit will be happen. One party will win, other party will lose. So many people raise the questions that how to know that open interest is for the positive side or the negative side. So for that we combine the price movement to understand the money flow of the market.
Register for our free webinar. Download our app today. Link in description.
understand the money flow of the market. Open interest works different at the different market scenario. We'll also learn that. So first, try to understand what is the open interest exactly. Everyone knows that open interest means the position which are opened yet not settled or has to be settled. But how the open interest is being calculated, that we need to understand. So first I'll use this example and then we'll go into the Excel to understand how exactly the open interests are being calculated in the market and what is the importance of the open interest versus the difference of the volumes in the markets. So here I have mentioned an example about understanding the open interest. So here we have considered the 6 members are trading. Let's say the Monday is the first day of the particular contract in the future segment and there are 6 traders A, B, C, D, E. Let's start, all the traders are trading into the particular contract and that contract just started. So on Monday, person called A has taken the 6 long positions, B has taken 4 long positions and C has sold 10 short positions. You need to understand, open interest net will be same, all the plus will equal to all the minus, because without buying contract cannot be sold. If someone is buying, the other will be selling, then only the transaction will happen. So here in this example, what we have noticed, A and B has bought 6 plus 5 contracts respectively, while C has sold 10 contracts. So if I understand that the volume, 10 lots has traded. Now open interest is also 10 because A is having 6 open position on the long side, B is having 4 position on the long side, C is having 10 short position on the short side. Now if I combine long to short, I am having the net to net 10 position open. So open interest 10 means 10 positions are on long side or 10 position are on the short side. Now look at this date, second date, that is the Tuesday. So here A has not traded anything, B has not done anything, C has taken 8 long positions. The open interest is running net total. So you need to understand also that what was the previous position of trader C. C was earlier having minus 10, but now he has taken 8 longs. Now look at the D. He was not having any positions earlier, but on Tuesday he has taken the 8 position on the short side. So on Tuesday only 8 lots traded. C has bought while D has sold. So if we ask at the volume, that is 8, but open interest is 10. Now how the open interest is 10? Volume is 8, but open interest is 10. We need to now understand that if we look at the open position now, A is having 6 lots at the end of Tuesday. B is having 4 lots because no open interest has changed, so they are having the existing positions of 6 long and 4 long, A and B respectively. Now talking about the C was earlier having this 10 position on the short side, but now he has bought 8. So net to net he is having minus 2 on the selling side. And D was not having earlier any positions, but now he has sold 8. So if I look at the net open interest at the end of Tuesday, I am having 10 position on the long side and 10 on the short side. How 10 and 10? Because A and B are the net longs to 6 plus 4, while C, which was earlier having the short negative position, which earlier shorted the positions on 10 lots, now added 8 on the long side. That means reduce negative position of 10 and now to 8, and now he's having only 2 on the shorting side. So at the end of Tuesday, A and B are having 6 plus 4 long, while D and C are having minus 2 and minus 8. So net to net the open interest is a 10 lot, while the volume is 8 lots. Now if I look at the change in open interest, at the end of Monday the open interest was 10, at the end of Tuesday open interest is 10, open interest is same, while the volume is 8 but open interest remains same. So what is the change in open interest? There was no change in open interest if I compare from Monday to Tuesday. Now look at the Wednesday. On the Wednesday, A has not traded anything, B, which was earlier having 4 lots, added 2 more longs. So if I look at the end of the Wednesday, B is having 6 net long positions. Now look at the C. C was having minus 10 on the Monday, plus 8 on the Tuesday. So towards the end of the Tuesday, he was having minus 2. But on Wednesday, he has added 2 on the long side. So open interest is 0 towards the end of Wednesday. D, which was on the shorting side of the market by minus 8 on the Tuesday, has added more minus shorting 7 lots. D has added 3. So what we are noticing here, net to net long and shorts will remain same. Now if you look at the Wednesday, plus 2 minus 3 are net to net plus 7, and D has sold minus 7. So net to net buyer and seller quantity will be similar in the market. Then only the open interest will happen, or then only the trade will happen. So if I look at the volumes, exactly the 7 lots, because 7 were buying side, 7 on the sell side. But now what is the open interest? The open interest is 6 net positions total for the A side, total 6 for the B. So 6 plus 6, 12 on the long side. E also added the 3 long positions, so 15 on the long side on the ending of the Wednesday. Now look at the shorting side. So D was having minus 8, he added minus 7, so minus 15. And now look at the C, minus 10 plus 8 plus 2, so net to net 0 at the end of Wednesday. So my net open interest is 15. Why 15? 6 long A, 6 long B, that is total 12, 3 long for E, that is total 15, while D is having the open interest of minus 15. So that's why you notice here the volume is 7 lots while the open interest is changed to 15 lots. The earlier open interest was 10, now the open interest is changed to 15. So change in the open interest by 15%. Now look on the Thursday. On Thursday, B added 5 lots on the long side. D has taken the 10 lots on the long side, while earlier he was having net to net 15 on the short side. So his position has reduced from plus 10, from earlier minus 15. So net to net minus 5 lots on the shorting side. D, which was earlier having 3 long, added 10 more longs. He is having more bullish bias. So net position is going 13 longs. F shorted 25 lots. Now if I look at the volumes, obviously that is 25 lots. F shorted while B, D and E has taken the long position, respectively 5, 10 and 10. So volume is 25, but open interest is 30. How 30? 6 position is pending from A side. Look at the B, 4 plus 2 plus 5, total is 11. So A plus B, total 6 plus 11, that means 17. So 17 positions are open from A plus B on the long side. If you look at the C, net to net 0. Now look at the D. Earlier he was having minus 15, added 10 on the long side, so position is minus 5. E has taken the 13, E has taken 10 lots more, so net to net 13. So if I combine the positions, 13 long from the E side, 6 from A side, so that goes to 19, and 11 from the B side, that goes to 30. If I look at the short positions, F has sorted 25 lots, while D is having minus 5 lots as open interest. Minus 8, minus 7, 8, minus 8, minus 7, plus 10. So 5 positions on the short side. So open interest is gone to 30. What was the earlier open interest? 15 on the Wednesday end. Now Thursday end the open interest is 30. So 15 to 30 the open interest is jumped by around 100%. Now look at the Friday. A has not done anything. Is already having the existing 6 lots on the long side. B plus 4 plus 2 plus 5. So net to net he was having 11 positions, but on Friday he reduced the 10 lots. He has done minus 10, but that is reducing the long positions. On Friday he has done the shorting, but shorting was done because earlier he was having the long positions of 11 lots. So now the net open interest of the B will be plus 1. Now look at the C, net position is 0. Look at the D, net position will be minus 5. Look at the E, net position was plus 13, but on Friday it reduced minus 10, so open interest will be plus 3. Look at the F, earlier he was having minus 25, but on Friday he has added 20 lots, so position will be minus 5, net to net. Now if I look at the volumes, net to net the volume is 20 because F traded on the 20 lots on the long side, while E and B has taken the 10 lots on the short side respectively. So volume is 20, but open interest is 10. Volume has decreased by only 5 lots, but open interest has decreased by 66%. How 10 lots? Now come to the net running total. A plus 6. If you look at the B, only 1, because 4 plus 2, 6 plus 5, 11, minus 10, 1. So total 6 from the A open interest, 1 from B, no position from C side, minus 5 from the D side, and plus 3 from the E side, and minus 5 from the F side. So if I now do the total, plus 6 plus 1, that is 7, plus 3, that is total 10, and minus 5 from the D side and minus 5 from the F side. So open interest is 10 while the volume was 20. So we need to understand volume may happen to any quantity into the derivative segment.